Hello, and welcome back. For a lot of investors, the math just isn't mathing anymore. You look at your bank statement, you look at the rental income coming in from your long-term tenant, and then you look at the mortgage payment going out. For many, that equation is resulting in negative cash flow. You are bleeding money every month just to hold on to the asset. So, naturally, the mind starts to wander. You start looking for alternatives. You start scrolling through Instagram or TikTok, or you simply browse the web, and you see it, Airbnb. You see the screenshots of people claiming they're making double, triple, even quadruple the rent of a standard lease. You think, wait a minute, why am I accepting $600 a week for a 12-month lease when I could be making $200 a night? It sounds like the perfect solution, doesn't it? A way to turn that negative cash flow into a river of passive income, maybe even enough to retire early. But is it actually that simple? Today, we're doing a deep dive. We're going to strip away the hype. We're going to look past the shiny revenue screenshots and talk about the gritty reality of short-term rentals. We're going to answer the big question: is handing your investment property over to Airbnb actually a good method, or are you just trading one headache for a much more expensive migraine? Grab a coffee, settle in. Let's get to work. Segment 2. The allure: why everyone wants in. Let's start with the why. Why is the temptation to switch to Airbnb so strong right now? It really comes down to one word: yield. When you look at the raw numbers, the disparity is shocking. If you're operating a traditional long-term rental in a standard residential area in Australia, your yield, that is, your annual rental income divided by the property value, is likely sitting somewhere between 3% and 4%. If you're incredibly lucky, or perhaps you bought in a high-growth regional pocket at the perfect time, maybe you're seeing a gross yield of 6% or 7%. But let's be honest, 3% to 4% is the average. In a high-interest rate environment where your mortgage might be 6% or 7%, that 3% yield feels like a joke. It's barely covering the interest, let alone the principal or maintenance. Now, compare that to the short-term rental market. When you look at Airbnb yields, we are often talking about a gross yield of 10% to 15%, sometimes even higher if you have a unique property. Just pause on that for a second. You have the same four walls, the same roof, the same location. But by changing the business model from housing to hospitality, you are potentially tripling your gross revenue. When you visit the Airbnb website and see the nightly rates, $300, $400, $500 a night for a standard apartment, it's mind-blowing. It's very easy to do the napkin math and think, I'm sitting on a gold mine. And it's not just the money, is it? There is a lifestyle component that seduces a lot of investors. We call this the flexibility factor. If you sign a standard 12-month lease with a tenant, that property is gone. You cannot enter it without notice. You certainly can't sleep there. But with Airbnb, you retain control. Let's say you own a property near the beach or in a nice city fringe suburb. You can choose to rent it out during the peak season, summer holidays, big events, to maximize that cash flow. But then, when the market is quiet, or perhaps during a specific week when you just want a break, you can block out the calendar. You can go stay there yourself. You can let your family stay there for Christmas. That is a very attractive proposition, an asset that pays you money and serves as a holiday home. With a long-term tenant, you might own the house, but you never really get to enjoy it. With Airbnb, the door is always open for you, provided you're willing to forego the income for those dates. So on the surface, it looks like a no-brainer. High yield, personal usage, massive revenue potential. Why isn't everyone doing this? Well, as with everything in investing, if it looks too good to be true, you need to look closer. Let's turn the page and look at the hidden downsides that nobody puts in their YouTube thumbnails. Segment 3. The banker's cold shoulder: financing risks. The first major hurdle is one that most people don't think about until it's too late. It's your relationship with the bank. You might think, my bank will love this. Look at all this extra income I'm making. Wrong. Banks are conservative beasts. They crave stability. They love a boring, signed, 12-month lease agreement with a salaried tenant. That is predictable. That is safe. Airbnb income? To a bank, that looks like chaos. It's seasonal. It fluctuates. It relies on tourism trends. Because of this instability, Many banks simply will not consider Airbnb income when calculating your borrowing capacity. Let's say you want to buy your next investment property. You go to the broker and show them your Airbnb ledgers. They might turn around and say, "Sorry, we can't use this." Or, if they do use it, they will apply what's called shading. They might take your actual Airbnb income and discount it by a massive margin, often 40% to 50%. Think about the impact of that. You're doing all this extra work, taking on all this extra risk, generating, say, $50,000 a year. But the bank looks at it and says, "We're only going to count $25,000 of that." This creates a paradox. You might have more cash in your pocket at the end of the month, but your ability to borrow money to grow your portfolio has actually decreased because the bank views your income stream as unreliable and high risk. If your goal is to build a large portfolio of properties, switching to Airbnb might actually put the brakes on your borrowing power. Segment 4. The regulatory storm. Now let's zoom out from your bank account to the broader community. We have to talk about policy risk. You need to understand the climate we are operating in. Currently, in Australia, less than 20% of investment properties are used for short-term rentals like Airbnb. It's a niche market, but it is a very loud niche. There's a growing chorus of voices from neighbors, local councils, and housing advocacy groups who are strictly against Airbnb. The argument is that by turning long-term housing into short-term hotels, investors are exacerbating the housing shortage and driving up homelessness. Whether you agree with that or not doesn't matter. What matters is the political risk. Because of this pressure, there are many people advocating for strict bans or caps on Airbnb. We're already seeing this in cities like New York, and we're seeing tighter regulations in places like Melbourne and Byron Bay. You might spend thousands setting up your Airbnb, only for the local council to introduce a new rule 6 months later that limits you to renting it out for only 90 days a year. Or they might slap you with a massive council rate hike. This is a risk you do not face with a standard residential lease. The regulatory ground beneath your feet is shifting, and you need to be prepared for it to potentially swallow your business model. Segment 5. The hidden costs of entry. Let's move on to the actual mechanics of running the property. Let's talk about money again, specifically the money you have to spend before you even get your first guest. When you buy a long-term rental, what do you need? A clean house, maybe some fresh paint. That's it. The tenant brings their own bed, their own sofa, their own spoons. With Airbnb, you are providing a full-service product. You are not just providing a roof. You're providing a lifestyle. This means you need to furnish the place. And I don't just mean throwing a mattress on the floor. To get those high nightly rates, the furniture needs to be stylish, durable, and comfortable. You need appliances, linen, artwork, cutlery, Wi-Fi setups, smart locks. For a decent-sized property, this setup cost can easily run into the tens of thousands of dollars. Some investors I know spend a fortune buying furniture and doing renovations specifically for Airbnb. And here is the kicker. That money is an upfront capital expense. It significantly dilutes your return on investment in the first few years. And it doesn't stop at setup. You have the platform fees. Airbnb takes its cut. You have insurance. Landlord insurance for a long-term tenant is relatively cheap. Short-term rental insurance? That is a specialty product, and the premiums are high. You are insuring against transient guests who have no stake in the property, which is a much higher risk profile for the insurer. So, when you see that 15% yield on paper, start subtracting. Subtract the furniture. Subtract the platform fees. Subtract the insurance. The number starts to shrink very quickly. Segment 6. The management trap. This brings us to the operational side. And this is where the passive income myth really falls apart. If you have a long-term rental, you pay a property manager. In Australia, the standard rate is around 7% to 8% of the rental income. For that fee, they collect the rent, inspect the property every few months, and handle the paperwork. It's relatively set and forget. Now look at Airbnb. Property management fees for short-term rentals are significantly higher. You're looking at paying 15% to 20% of your revenue to a manager. Why so high? Because the workload is 10 times higher. We aren't talking about checking the rent once a month. We are talking about managing a hotel. Guests are checking in and out constantly, sometimes every 2 days. The cleaner needs to be coordinated. The linen needs to be laundered. The keys need to be handed over. And even if you pay that 15 to 20%, you are still likely to be involved. You will still have to deal with the property manager frequently because things go wrong much more often with high turnover. Guest communication is intense. They ask questions before they book. They ask questions while they are there. They complain if the Wi-Fi is slow. If these issues aren't resolved instantly, you get a bad review. And on Airbnb, a few bad reviews can destroy your search ranking and kill your income. So, you're paying triple the management fees for a service that still requires more of your mental bandwidth. Segment 7. Maintenance and occupancy nightmares. Let's talk about when things break. Because they will break. In a long-term rental, if the hot water system plays up, the tenant calls the agent. The agent calls a plumber. Maybe the plumber goes out on Tuesday. It's annoying, but it's manageable. In an Airbnb, the guest is paying per night. They are on holiday. If the hot water breaks, it is an emergency. If the air conditioning fails in summer, it is a crisis. You cannot wait until Tuesday. You need a trade person now. This means you are often paying for emergency repairs. You're paying for call-outs at midnight, on weekends, or on public holidays. These costs are often double or triple the standard rate. If you don't fix it immediately, you have to refund the guest. So you lose the income and you pay the emergency plumber. It's a double whammy. This leads us to the final variable, occupancy rate. When you do your calculations, do not assume your property will be full 100% of the time. That is a fantasy. Owners generally hope for an occupancy rate of around 70%. Now, if you're in a prime location, Bondi Beach overlooking the water, or right in the CBD, you might hit 90% or even 100% in peak seasons. But what if you are in a secondary suburb? What if there's a recession and tourism drops? In many areas, the occupancy rate struggles to reach 40% or 50%. If your occupancy drops to 50%, but your costs, such as internet, electricity, council rates, insurance, remain fixed, your profitability evaporates instantly. You still have to pay the mortgage every month, but the income is volatile. Segment 8. The verdict. Who is this for? So, we have covered a lot of ground. We've looked at the high yields, the bank issues, the regulatory risks, the setup costs, the management fees, and the maintenance headaches. The question remains, should you do it? There is no simple yes or no. It depends entirely on you. I want you to take a hard look at your situation. You need to calculate if that shiny 10% to 15% yield is actually real. After you deduct the 20% management fee, the cleaning, the electricity, which you pay, not the tenant, the internet, the high insurance, and the emergency repairs, is the net profit actually higher than a standard rental? Is it worth the risk? Is it worth the hassle? Here is my profile of the person who should do Airbnb. If you only want to own 1 or 2 investment properties. If you have plenty of spare time and you are willing to get your hands dirty. If you're willing to manage it yourself, meaning you answer the messages, you coordinate the cleaners, maybe you even do the maintenance yourself. By doing this, you save that 20% management fee and the maintenance costs. If you genuinely enjoy hospitality and dealing with people, then this strategy can be a home run. You can maximize your return significantly. However, here is the profile of the person who should avoid it. If you are busy, if you have a demanding full-time job, if you want passive income where you just check your bank account once a month, if you want to build a large portfolio of 5 or 10 properties, if you rely on bank lending to keep buying. In this case, Airbnb is likely a trap. It's a job, not an investment, and it's a job that might stop you from borrowing money for your next asset. Segment 9. Conclusion and next steps. To wrap this up, Airbnb is not a magic bullet. It is not suitable for everyone. Just because your friend is doing it or you saw a video about it doesn't mean it will work for your specific property or your specific financial goals. It requires a completely different mindset. You are moving from the real estate business into the hospitality business. Those are 2 very different worlds. You need to analyze your specific property, your available time, and your long-term plan before making this switch. Here is my challenge to you for this week. If you're considering this, Don't just guess. Run the numbers. Open up a spreadsheet. Column A long-term rental, rent times 52 weeks, minus 7% management, minus standard costs. Column B, Airbnb. Be conservative. Assume 60% occupancy. Deduct 20% from management. Deduct $2,000 a year for electricity. Deduct the internet. Deduct the cleaning. See what the bottom line actually looks like. The difference might be smaller than you think. Remember, investing is a marathon, not a sprint. Make sure you're wearing the right shoes. Thanks for listening, and I'll catch you in the next episode.